Imagine it's 1984. A young, relatively unknown investor named Warren Buffett stands before a crowd at Columbia Business School. He's about to deliver a speech that will become legendary. A speech that could forever change how you think about investing. He poses a simple question. What if you held a national coin-flipping contest? 225 million Americans, each bet $1. Every day, those who call the flip wrong are out. After beta days, you'd have about 215 people left who have won 20 flips in a row. They'd feel like geniuses, right? They'd write books, go on talk shows, and share their secrets to coin flipping. But was it skill or just pure luck? Now, Buffett asks, what if you found that all 215 of these winners came from the same small town, say Graham-and-Doddsville? Suddenly, you wouldn't dismiss it as luck. You'd investigate. You'd want to know what they're doing differently in that town. Hello, and welcome to WealthNetic channel, where we decode the psychology of wealth to help you make smarter financial decisions. Today, we're taking a trip to that metaphorical town of Graham-and-Doddsville. We're going to uncover the secrets of the Superinvestors, a group of individuals who consistently beat the market not by luck, but by following a shared, disciplined philosophy. By the end of this video, you'll understand the 3 core principles that bind these legendary investors together and how you can apply their timeless wisdom to your own strategy. We'll explore the power of thinking like a business owner, the critical importance of a margin of safety, and why treating the market like a moody business partner is your greatest advantage. So, are you ready to learn from the best? Let's get started. The first, and perhaps most fundamental, principle that unites the superinvestors is this. They don't see stocks as flashing ticker symbols on a screen. They see them as fractional ownership in a real business. This is the cornerstone of what's called value investing, the philosophy pioneered by Benjamin Graham and David Dodd at Columbia University, the Vera Graham-and-Doddsville from Buffett's speech. Think about it this way. If you were going to buy a local coffee shop, you wouldn't just look at its daily sales figures. You'd want to know everything. What are its profits? Who are its competitors? How loyal are its customers? Does it have a lot of debt? You do your homework because you're buying the entire business, not just a piece of paper. The superinvestors apply this exact same logic to buying stocks. They are business analysts first and investors second. They're not interested in guessing which way the market will swing tomorrow or next week. They're interested in one thing: determining the underlying, long-term value of a business. This is what Ben Graham called its intrinsic value. They ask, if I were to buy this entire company, what would it reasonably be worth? Only after answering that question do they look at the stock price. This mindset shift is profound. It moves you from being a speculator, betting on price movements, to being a business owner, investing in long-term value creation. It forces you to ignore the noise and focus on the fundamentals, the actual health and prospects of the company. It's the difference between gambling on a horse race and owning the racetrack itself. So, how do you find that intrinsic value? And more importantly, how do you make sure you don't overpay for it? That brings us directly to our second principle. The second pillar of the Graham-and-Doddsville philosophy is the margin of safety. This concept is your ultimate defense against errors, bad luck, and the wild swings of the market. Benjamin Graham famously said, "The margin of safety is the 3 most important words in investing." So what does it mean? In simple terms, it means buying a business for significantly less than its intrinsic value. Imagine you're building a bridge. If you calculate that the bridge needs to support a maximum of 10 tons, you don't build it to hold exactly 10 tons. You build it to hold 20 or even 30 tons. That extra capacity is your margin of safety. It protects you from miscalculations, unforeseen stresses, or just plain bad luck. The superinvestors apply this engineering principle to finance. After they've done their homework and estimated a company's intrinsic value, say, they think a stock is truly worth $100 per share. They don't buy it at $95. They wait until they can buy it at $60 or $50. That massive discount is their margin of safety. Why is this so critical? First, it protects your downside. If you were wrong in your valuation and the company is only worth $70, you still bought it at $50, so you're protected. If the economy takes an unexpected downturn, your cheap purchase price provides a cushion. Second, it provides a massive upside. When the market eventually recognizes the true value of the business, the stock price has more room to grow from $50 back to $100 than it would from $95. A study from the Journal of Finance analyzing decades of market data found that portfolios built on value stocks with a significant margin of safety consistently outperformed the broader market over the long term, with lower volatility. This isn't just an American phenomenon. The principle is proven effective in markets across Europe and Asia as well. Buying with a margin of safety is the single best way to enforce the #1 rule of investing. Never lose money. But how do you find these bargain prices? The market isn't just giving away great companies, is it? Well, sometimes it does. Which leads us to the third and final secret. The third secret of the super investors is how they view the market itself. They don't see it as an all-knowing judge of value. Instead, they personify it, using an allegory from Ben Graham. Mr. Market. Imagine you have a business partner named Mr. Market. He's a bit of a manic depressive some days. He shows up at your door offering to buy your shares in the business for ridiculously high prices. Other days, he's in a deep panic, terrified, and offers to sell you his shares for pennies on the dollar. A speculator gets caught up in Mr. Market's mood swings. The super investor does the exact opposite. They understand that Mr. Market is there to serve them, not to guide them. They happily ignore him on his manic days. But when he shows up depressed and offers to sell a wonderful business at a silly price, they take advantage of his pessimism. They use his fear to build their margin of safety. This is where the actionable steps come in. Here's the WealthNetic system for harnessing the power of Mr. Market. Step 1. Make a watch list of 10 to 15 wonderful businesses you'd love to own. These are companies with strong competitive advantages, solid balance sheets, and great management. Step 2. Do your homework. Calculate a conservative estimate of their intrinsic value. What would you be willing to pay for the whole company? Step 3. Decide on your margin of safety. Determine the price at which you're willing to buy, say, 60 cents on the dollar. Write these target prices down. Step 4, and this is the hardest part. Wait. Ignore the daily noise. Ignore the hype. Ignore the fear. You simply wait for the moody Mr. Market to offer you one of your chosen companies at your predetermined price. When he does, you act decisively. Step 5. Once you buy, your job is to hold on as long as the business remains a great business, letting its value compound over time. This system turns market volatility from a source of fear into a source of opportunity. So, let's bring it all back together. We've journeyed to the intellectual home of the world's greatest investors, Graham-and-Doddsville, and uncovered their 3 core tenets. First, think like a business owner, not a stock trader. Focus on the intrinsic value of the company. Second, always insist on a margin of safety. Buy great businesses only when they're on sale, protecting your downside and amplifying your upside. And third, treat Mr. Market as your servant, not your master. Use his emotional swings to your advantage. Buy in when he's fearful and ignoring him when he's greedy. Putting this into practice isn't easy. Our brains are wired to follow the crowd, to get excited when prices are rising and to panic when they're falling. It's a clear, logical, and time-tested path to building real, long-term wealth. You don't need a supercomputer or inside information. You just need the right mindset. Resisting that urge requires discipline and a strong psychological framework. But as the super investors have proven over decades, it's a framework that works. Thank you so much for investing your time with us today at WealthNetic channel. If you found this breakdown valuable, please hit that like button and subscribe to the channel so you don't miss our next deep dive into the psychology of wealth. We'd love to hear your thoughts in the comments below. Which of these principles resonated with you the most? Thanks again for watching, and we'll see you in the next video.